Welcome to the Lending Forward podcast, brought to you by Atlantic Bay Mortgage Group. This is your home for real discussions about the mortgage and housing industry. Our hosts are here bringing you firsthand accounts from people at the heart of the business. And we're chatting with professionals from all corners of the industry as they help cultivate transparency around the future of the industry we love. Together, we are lending forward all we know to you. Thanks for joining us for today's episode. Let's dive in. This episode is sponsored by Optimal Blue. Optimal Blue helps lenders maximize profitability on every loan transaction so they can keep helping more people achieve the dream of home ownership. They're the only industry partner offering a complete capital markets platform that connects pricing, hedging, trading, compliance, and analytics in real time. That means unrivaled pricing accuracy and margin protection, end-to-end capital markets automation, cloud-native API-first scalability, seamless connectivity with 70-plus integration partners, and real-time data paired with AI-powered insights to drive loan-level ROI. Optimal Blue delivers more value without added cost, so you can move faster, stay compliant, and grow smarter. Learn more at optimalblue.com.
Welcome back to Lending Forward. Today, we're diving into the intersection of housing, fintech, and what's next for real estate in one of the most complex markets we've seen in decades. My guest is someone who's been at the forefront of this space for over 20 years, Julian Hebron, founder of The Basis Point. Julian's worked at the highest levels of both legacy institutions and fintech disruptors, and now runs a media and strategy consulting company that helps lenders navigate a constantly shifting market. Hey, Julian.
Hey, Hannah. Great to be here.
That was a mouthful of an intro, but
yes,
you have been around the block.
Yeah, been around for a minute, for sure.
Well, I'm really excited to have you on. I know we have a ton to talk about, so I want to dig right in. I want to start with The Basis Point. You launched it back in 2008. Which was not exactly a calm time in our world. Tell us about it. What gap were you trying to fill when you launched it?
Yeah, well, so it incorporated in April 2008, but I actually first bought the domain for thebasispoint.com in just before Thanksgiving 2007. And if everybody remembers, August 2007 is when the great financial crisis first hit the mortgage sector. And then it took about a year for it to hit the rest of the world. I, at the time, was a producing branch manager for a mortgage bank called RPM Mortgage in California, which is now part of Cross Country. And this is very old school, but was writing the biggest way that I got all my business for myself and the teams that I managed was a weekly newsletter, and it was always on Fridays, and it was just 2 paragraphs, and it was very succinct. And on that week of August 7th, I started expanding that newsletter because I had previously come from the money management business into the mortgage business back in 2003. And so I really did understand markets well. And there was this era, I think we can all admit, where the loan guidelines were pretty flimsy. There was a lot of loan officers out there who didn't know capital markets very well. So I started writing much longer pieces to explain to realtors, financial advisors, and customers what was going on as the world was unraveling in the financial sector. And we ended up getting a lot more business when everybody else was falling out. And so as I started turning it into this brand called The Basis Point, but it was always meant in those years to support production and managing of production. So that's how it started. If you fast forward to 2018, we did consulting work over the years while I was still a mortgage banker. But June 2018, which was 7 years ago this month, is when we took it into a full-time, as you said, media and strategy consultancy for banks, lenders, and fintechs. But in those early years, firms like Zillow were coming to us and asking us questions just because of the blogging that we were doing in the newsletters. So it kind of evolved, and I launched it as a full-time endeavor in June of 2018. So 7 years in as a full-time endeavor.
That's awesome. Well, happy anniversary.
Thank you. That's right.
That's a great story. Well, you've worked inside massive institutions. How did those experiences shape the way, you're really helping companies today think through strategy and innovation?
Uh, I like the scale institutions as well as the ground level IMB cultures, and I've been very fortunate to have exposure to both. And the basis point sensibilities and my own personal sensibilities are informed by both, because one thing I've always loved about the industry, you've got over the last 30 years, 2.02 trillion per year in new originations. As of this quarter right now, we're at about 14.6 trillion in servicing outstanding. So these giant, we're just part of this giant sector that has room, as you say, for the majors, as well as for firms that want to be more boutiquey. And boutiques can be anywhere from 2 billion to almost 10 billion, because I feel like what I learned over time is once you go over 10 billion in originations, that's when it starts to get more complex. And then each 5 billion the next couple five until you get to like above 30-ish is where it starts to get more complicated to manage a big firm, keep culture intact, etc. And frankly, keep your focus. Say from a channel perspective. So I've had the good fortune of seeing how all these things work. And I will say this about the bigs. Servicing is very, very helpful for the bigs because it helps weather these down cycles. But then the bigs have challenges with things like channel conflict. The retail side can be like, hey, wait a minute, is the direct side going to be going after customers that I brought in? There's all these extra complications at the bigs, but I think it's important to have all these perspectives. And in the end, the firms that know how to focus and keep each of those channels happy, if it is multi-channel, which it usually is in the bigs, that's the biggest thing that those big orgs contend with on a daily basis on the ground. That's what those management teams are working on, is keeping everybody happy.
Mm. Well, I'm really excited to have you on and have just your brain power sharing information with all of our listeners. So I do want to talk a little bit about, innovation and just the disruption that technology is really having in this space. There's a lot of buzz around innovation in mortgage and banking right now. But, I think we also know there's a lot of noise. So from your perspective, I mean, what are the most impactful innovations, truly reshaping the mortgage and banking space right now?
Well, let me start by just sharing another little milestone that we've been working on this week, where our team has been very close with National Mortgage News and their digital mortgage conference since the beginning. And the one that they're doing this September 15 to 17 in San Diego is the 10th anniversary. So
Awesome.
we were just doing some public promos for that yesterday, and I was sort of going back and saying what was going on then, because it was hot then with mainly POS and CRM, right? These were the two biggest things that were going on then. And if we fast forward, there's been progress there. I think we can talk a little bit about that, but the stripping out of the hype is probably the thing that we try to do the most. We're at once, the basis point is at once a booster of, but also a pragmatic gut check for all of these cycles. And we try to be a historian on all of these things. So what I could say is that if we're looking at like things that are currently reshaping the mortgage banking space, I'll talk a little tech as we go through this, but I want to kind of do it more thematically, if that's okay.
Yeah.
Okay. So to start, like the most important innovation, which I don't even know if I would call it an innovation, it's the most important theme, I think, that's shaping innovation, which is this convergence that we're seeing of originations and servicing with some of these big deals that we've seen this year. Rocket Cooper, Guild Bayview being two notable ones, right? And if we view that through a technology lens, servicing technology is drastically more complicated than originations technology. And we know that, like, if LOS is the gold standard of difficulty on the origination side, servicing systems of record have three main components. That you've got your performing, your non-performing, and then of course the consumer components have to run all the way through that. And this is where the tech itself is one thing, but what's the theme? The theme, why are these deals happening? It's because of what we've talked about for at least 10 to 12 years as an industry, customer for life, right? And so if we think about customer for life in a 2025 context, that's why these deals are happening. It's an acute purchase market. It has been since 2022, and you have the borrower for up to 12 months because it takes longer to find a place, et cetera, in originations. But if you're doing your job right in servicing, including the tech that powers it, you can have them for life. Servicing is where that relationship is managed and grown. But on the origination side, what if you're not retaining servicing? Can you still run the same customer for life playbooks? Absolutely yes, right? So that's a lot, but I'm happy to field any follow-up questions on that, because that's kind of how we view the world and the tech that powers it. We view it across this entire originations and servicing spectrum.
I actually am really glad you brought it up, because it has been such a hot topic with these, acquisitions and these mergers that have happened. And as a origination or as an originator, I mean, I think there's a handful of lenders out there that are scared, right? Like, oh my gosh, how am I going to keep up? They now have, what was the stat I saw? Rocket now has 1 in 6 loans. Is that right?
Correct.
How do lenders keep up with that?
Yeah. Well, let's do some stats that don't get covered that matter.
Okay.
The market share, the combined market share, let's just use Rocket Cooper Redfin. I'll do Rocket Cooper Redfin on the origination side, and I'll do Rocket Cooper on the servicing side, right? But from a market share standpoint, I'll go back to that previous remark, 2.02 trillion per year in originations per year. And just to be specific, the MBA June 20 is their latest projection, and it's 2.04 trillion that they're projecting for 2025 in originations. Of that, the combined originations from Rocket, Cooper, and we know that Redfin, had bought Bay Equity, and they had originations in there as well. We calculate at being somewhere between about 7.2 and 7.5% market share on 2 trillion a year, right? So think about that. 7.5. That's the overwhelming rest of the annual market share is for everybody else. So that's what everybody should take away. That's what loan officers at Atlantic Bay should take away. That's what everybody should take away. The same goes on servicing. Servicing is innately more concentrated than originations, but if you take Rocket Cooper and combine that, it's very meaningful. It's 2.1 trillion in servicing. I mean, kudos to those teams for combining, and that is powerful. But it's 14.7% market share. So again, 85% of the market is still left over for everybody else. So that would be my answer to that is, don't get too caught up in the headlines. That's the math, and there's plenty of market share for everybody else.
I love that. And thank you for bringing those stats, because I haven't seen those stats. You always get caught up in the negative stats.
Yeah. You got to calculate them manually. That's why they're not out there as much. That's what we do.
I do love that. Well, knowing that there is so much market share out there and we all need to be going to get it, innovation is important. You have to constantly be innovating. But I want to hear it from you. What is the importance of innovation in the housing industry?
So, I think a pragmatic, like, let's, if we just said, over this last 10 years, there's been some core things in originations. It was just simply about modernizing. And if we think going back to this idea of POS, Why did POS come to be? It came to be because mainly LOS is serving this system of record function. It's not meant for people, like especially on the sales side, the LO side of the house, right? Where you're not supposed to be crawling around in this wildly complex software. You need to be nimble. You need to be advising your customers. You need to be calculating LTV, DTI, and getting these people approved. And of course, I mentioned CRM. You need to be getting these folks in the door, and you need to be incubating them to the time that they're ready to have those more detailed conversations. So these things, this is why these have been a priority. They are still a priority. Mm-hmm. So what's happening though is that we're, from a cost standpoint, and this is important, if we go back 10 years ago, the cost to do a loan today is, according to the MBA's latest stats, is $12,579. A lot of people know this stat. What a lot of people don't pay as close attention to is, if we back up 10 years, it's 63% higher now than it was 10 years ago. Yet we've supposedly had all this innovation that was supposed to help. This is not a knock on the innovators. It's what it is that phase one was modernization. It was going from paper to digital. So it's not surprising that we haven't moved the needle that much on cost per loan, but we have modernized our shops. We work with our consumers in much more sophisticated ways. We meet them the way they want to be met. That's what's happened in the last 10 years. The next 3 to 5, according to the basis points thesis, would be the ROI phase of the fintech era. Phase one was modernization. Phase two is the ROI phase. And this is where AI shows potential. So we like to look at AI through a very pragmatic lens. The hype years were these past 2 years. Now we are into implementation and ROI on AI. So I'd be happy to hit some of that if you would like to. But that's how we like to frame it. It's not like, gee whiz, AI. It's more like, can it usher in the ROI phase?
And I would love for you to dig in, because I wanted to ask you a little bit about what innovation and AI we know is here. It's not going anywhere. It does have a lot of hype around it, but what's actually going to drive the change? What's actually going to help the ROI and bring the cost to originate a loan down?
Yep. So let me set that up with a couple of stats. So
I love all of these stats, by the way. So bring
okay, we wouldn't be on brand for the basis point if we didn't have stats. So of the 12,579 sales, loan officers, that's 26% of it. Okay. So it's a meaningful chunk. It's a little over a quarter. There's always talk about, well, the tech's going to come. Before AI, it was whatever previous tech is going to come and reduce that LO cost. And now it's AI. There, maybe there's some potential to lower the 12,579. But of the sales component that comprises 26% of that, the basis points thesis is not in retail that LOs would be trimmed out of that. On direct, maybe so, because the direct model is just fundamentally different. But for an Atlantic Bay audience today, we're not talking about that. Let's talk retail, right? And so on retail, I think that AI has some ways of helping LOs, but LOs are the ones that bring in the business, and they will not get relegated by AI technology. That's our stance. So how can it help? Mm-hmm. It helps more in production. Okay. Now, production categories called fulfillment and production support, processors and underwriters. Of the 12,579, 21% of it is that. That's where maybe the needle can move a little bit, right? Because files per day, per week, per month, however each firm measures it, for processors and underwriters, and all firms measure it. Can AI come and help them? with like streamlining repeated paper chases, this thing that the POS wave innovated, direct to source data. Fine. That sounded cool until it was like, oh, but we can't do anything with the data. We're not analyzing it. We're not actually getting it into the 1003 properly and calculating our DTIs to actually approve these loans.
Mm-hmm.
AI is getting smart fast on being able to do that faster right up front. So it's doing two things. One, it's helping the LO get answers faster, but maybe it's also going to mean that fewer processors and underwriters can produce the same amount of quality analysis to guarantee that those files are compliant and that they're being approved correctly and that they are rep and warrant level ready to go when they're approved and closed.
Mm-hmm.
So that's what we think, is that LOs are less impacted. I'll do another hit later in our conversation about where it might help LOs a little bit more, but we think where AI should focus first is helping lower costs in fulfillment and production.
I like that. Okay, well, you touched on it, so I want to ask, how is it going to help LOs?
Yeah, so I think that there's a couple things, and this is where I'll sort of mix channels as well. On LOs, like here's what we've observed. It was marketing first, right? Just help me maybe help people like you, Hannah, create more content for your LOs that is compliant that you can give to them.
Mm-hmm.
And with respect to your operation and what you need to do and everybody in your shoes needs to do is keep LOs compliant. We know that LOs are also out there doing their thing too.
Mm-hmm.
So from a marketing standpoint, this mix of like pre-packaged content, hey, go to our content repository, set up schedules, be seen on social, make sure you're out there, but you got to use our stuff. It's compliant. And a lot of talk happens about compliance, especially in retail shops. And as it pertains to marketing, some smarter advanced use cases for AI is these LOs. As we know, the reason they go rogue on people like you, Hannah, is because they're like, well, that doesn't sound like me.
Yeah.
Right. One more layer on what you're doing with pre-packaged material that's compliance ready is you can still have the compliance firewall around allowing an LO to say, hey, AI, rewrite this for me.
Mm-hmm.
And then they get something that they have some agency in because they got to tweak it, but it's through an AI machine that has your compliance around it. That's one. And then adoption of the marketing tools that you've been looking to drive adoption on for years. And I work with a lot of people like you, so I do know this. It starts to, that's an advancement, not only for people in your shoes, but of course the LOs that you serve, right? But again, going back to these production technologies,
Mm-hmm.
even these LOs, along with the processors and underwriters that they work with, and at your shop, I know that you kind of called this the one team approach, where at Atlantic Bay, every LO gets dedicated processing and dedicated underwriting, right?
Mm-hmm.
But it's these three components, the LO component as well as the underwriting and processing components, are all using some of those newer AI production tools. They are getting answers faster. This matters on all files. It matters especially on the complicated files where it's like, we're not just W-2, we're like full tax returns, full 1120 business returns, and getting through those files fast and coming up with like closable pre-approvals. AI is moving the needle there.
Mm-hmm. It's exciting to see. I mean, I think all of the innovation and all of the, technologies that are coming out, it's really fun, but, you mentioned it, we all know it, with innovation comes risk, right? Yeah. So, what are the biggest risks lenders are facing when adopting new tech, especially around AI?
The basis points view on this is that the biggest risk of AI implementation is giving it directly to the consumer. The good news for shops like Atlantic Bay is that you're never going to do that. Your LO is your primary customer. So you're letting the LO work with the consumer, right? The direct shops are doing that. Better is a good example of leading the way on that with their Betsy AI. So to one of your previous questions, you're like, well, yeah, but how do I compete with that when, they're moving so fast on it? And one thing I had the privilege of hosting recently, and I think you're a total expert shop, right? And we hosted Total Expert on the Housing Wire gathering stage earlier this month, and we helped them launch their answer to that.
Mm-hmm.
The difference is this: there are humans, and very specifically loan officers, in the loop. This is this compliance phrase with AI, humans in the loop. What does this really mean for real? In your world, it's the LO is in the loop, but the TE level AI and that voice AI is the coolest thing I've seen since Betsy, because the voice is just like you and I are talking now. It's a natural voice. It's not a robot voice. There's these natural inflections. But because Total Expert on an advanced implementation like Atlantic Bay is tied into the LOS and the PPE and everything else, it has all the borrower data. So when rates drop, everybody at Atlantic Bay, every loan officer at Atlantic Bay, all at once, AI doesn't, have overtime or anything else like that. Rates drop, every customer in every Atlantic Bay loan officer's book can get contacted with, hey, rates dropped, and the loan officers aren't going to have to do this on these next dips. And it originates at least those conversations for them, but then it does come back to that loan officer. Mm-hmm. And that is meaningful, really meaningful. So I think that that's the part that I'm really excited about, is that it just masterfully puts LOs in the loop, but it does, going back to our previous questions, this is another way where loan officers, if you want to know how AI is going to help loan officers when we all have our opportunities to finally get into some refis again, this is how it's going to go.
Yeah. And I mean, we love Total Expert. Dan was on the podcast actually probably a month or so ago, but he was talking about the same tool. We're very excited about it.
Yeah. And we got into the weeds with them for weeks ahead of this thing. So we got to beat it up and call it and play the role of a tough customer that doesn't necessarily want to talk to what they think is a robot. And this thing is resilient. It keeps people's attention because it has their data. Mm-hmm. And it's referencing their loan officer by name. I'm a virtual assistant. I work with Hannah, your loan officer. Mm-hmm. Let's just take this one step further so that we can get it to Hannah. Mm-hmm. This is so sophisticated. It's really exciting.
I think it's really exciting too. And I think I'm going to play devil's advocate, because I hear this a lot when we talk, we're going to lose trust. We're going to lose consumers' trust. They know it's AI. They know it's a robot, whatever. How should companies really think about balancing this innovation, with compliance, but also with consumer trust?
Yeah. And our view on that, I've covered it a little bit, but and because I've had the chance both on the originations and the servicing side, I haven't mentioned some of these today. We don't have time, but what we have the privilege of doing is these companies let us beat up on their tech, on their AI agents. And these AI agents are getting so smart where usually, as I just said, they can handle it by invoking the humans that are involved. But critically, when a human taps out, in the same way that it works today with like IVR technology, where it's just if-then stuff, this is radically more sophisticated, but you can get to a human and it will actually schedule the calls for you. I don't want to talk to you anymore. I want to talk to Hannah. These agents will say, great, what's your schedule? Let's get you scheduled. And it walks you through that. We did this on stage 2 weeks ago on this exact topic because I wanted that topic about your question in there because this is the question everyone has.
Yep.
I don't trust you anymore. I want Hannah back. Great, let's get you scheduled with her. That's the answer.
I love that.
Yeah.
I love that. And I mean, I think, I think it's just going to take some adoption with loan officers, with companies to really get comfortable with it. Gosh, we are running out of time, and I have so many more questions to ask you, Julian, but I have to ask a couple more before I let you go. Sticking with that buyer behavior, that, do they trust you? Do they not trust you? I mean, how are tech innovation and, the shifting buyer behavior really impacting the way that lenders are operating today? I mean, I'm assuming it's tools like this that you're talking about, but is it?
Yeah. And here's what I think it's, we hear a lot like, well, how do we keep up? And the fact that lenders, again, in our 10-year framework of the innovation wave, have kept up, I don't think lenders aren't keeping up. Lenders do keep up with the tech. We need to remember that. We need to play offense on that. We as an industry are very good at optimizing the tech and the human mix. And I think we'll do the same with AI. It'll make us even better because it's smarter at making us better on it. So mortgage and real estate is where people still want to talk to humans. It's too important to trust robots, ultimately, to your points, with something like, people will do that with credit cards, whatever, but housing is just too important to trust it all to a robot. So I think we're doing fine there. But I think that the thing that we need, the crusade that we're on, and the crusade that I think a lot of your loan officers are on, is combating the social and the AI era misinformation about the viability of home ownership. So if AI can free up some time on the production and getting the loans done, the rest is combating all these headlines, social and mainstream media alike, that say American dream of home ownership's out of reach. It's not out of reach. We do these DTIs all day long, just like you do, just like all your peers do. And we all know as an industry that we can put people in homes every year, all the time. And that's the crusade. And if tech can help loan officers do that more, that's the win. And that's the focus to us.
I can't ask a question after that. That was phenomenal. That was the best way I could have asked you to end an episode. I love the passion and I love the positivity, and I think you're absolutely right. I love it. I do have one more because I do want to look into the future a little bit. Sure. I mean, as you're looking into 2026, 2027, how do you hope to see the industry evolve in the next couple of years?
I think this topic I just hit, as you can probably tell, we're deeply passionate about that. We think that misinformation only gets worse over time, and the American dream of home ownership is alive, and our job as an industry is to keep it alive. So that's the biggest one. But if you want to get wonked out for just like another 60 seconds or so, I would say that one of the big innovations of the last 5 years that is still scorchingly hot, but behind the scenes in other industries and still under radar in the mortgage industry is the potential for blockchain to reduce costs from originations from first quote to the consumer all the way through securitization and servicing, which is the role of blockchain. There are still some companies that are doing this and testing it quietly, keeping everything on chain behind the scenes. Figure is a good example here. They have great market share in the HELOC sector, and every single HELOC that they originate is natively on the Provenance blockchain. So they're proving these use cases. They are stripping out up to 100 basis points across that spectrum, bringing real-time trade and of course truly trustable QA where you don't have to do multiple verifications across. So as AI and blockchain come together to kind of, AI helps speed production as we've discussed today, but if blockchain can kind of be the single source of truth on that, the Basis Point still believes in that thesis. We understand that the mortgage sector is big enough to where it's hard to get every party from origination through securitization on board, but we still believe if you fast forward 5 years that that's going to be a thing.
That's really exciting.
Yeah.
Well, I can't let you leave, Julian, without asking. We ask all of our guests this question, and you already lent so much forward with all of this information, but how do you or the Basis Point plan on lending it forward for the rest of 2025?
focus, we're working on our 26 right now, but like every firm, yours included, if you're going to change your plans, it's going to take at least 6 months. So we have a thing where in our first 7 years, we've gotten involved, very fortunately, in so many things. We're feeling a little distracted from our core activities right now. So our thesis going into in planning for 2026 is all eggs, one basket, watch that basket.
I love it. Well, thank you so much for joining, Julian. We could not be more grateful for all the stats and all the info that you brought, and I hope that we can have you back on someday soon.
Would love to come back. Thank you.
Thanks. Bye.
Bye.
Thanks again for tuning into today's episode of the Lending Forward podcast. Be sure to subscribe to our channel, follow us on Instagram @LendingForward, on YouTube and LinkedIn. Catch us every other Thursday with a brand new episode, and go lend something forward today. Atlantic Bay Mortgage Group, LLC, NMLS number 72043, NMLSconsumeraccess.org is an equal opportunity lender and employer. Located at 600 Lynn Haven Parkway, Suite 100, Virginia Beach, Virginia 23452.